we hit the summer months of August, the bull market is still rearing its head, gold is still pressured, and volatility is either up or flat. But with me today to talk about some of the implications of the forthcoming regulations, or as we're saying, finally at implementation time, Udi Sella of Numerix. Udi, how are you, sir?
Fine, glad to be here. Thank you.
I am happy you're here. So let's just dive right in. Dodd-Frank is now 3 years old. Basel III is approved in the U.S. We've had the watershed moment of the CFTC in terms of alignment of, or intend to alignment for cross-border rules. But, you know, when we think back of the objectives, you know, set out back in G20, where we're going to have more centralized clearing, better transparency in trading, are the stated objectives, now that all these regulations are coming to market, aligning with the overarching goals?
Well, we define the goals as what? To have as safe trading, and that the public money will not be required again to save institutions, right? So, of course, you know, the risk is always from under-regulating to over-regulating. So the question is, what is the impact on the cost of making business? And that's one thing. The second thing is, would it be harmonized across different geographies? Or would there be regulatory arbitrage opportunities when one would trade at one center as opposed to another center to avoid, you know, to limit the cost of doing business? So I guess these are the questions that we need to ask ourselves. And also there's a question, do we favor now the listed market as opposed to the OTC market because we give incentives, or we make the transacting via listed markets less costly?
So one could argue that, especially with the cross-border rules, we're moving closer to harmonization, and that's kind of well underway. And that's also under the control of the regulators themselves. But where are we on the cost of business? I mean, one, presumably, costs now are going to rise.
Yeah, so clearly, as you say, costs will rise because there would be now an additional cost for when it gets to margining. So every time my position exceeds a certain threshold, I'd be required to post additional margins, right? And this would be for more trade types that were previously. So clearly, this would impact the cost of trading. Now, if you think of those corporates that hedge, pension funds, the cost for even for funding could rise. For instance, if you look at corporates that use FX swaps for funding purposes, so every time I have I don't know, I have a surplus in my dollar account and a deficit in my euro account, I can use FX swaps in order to roll my positions and make sure that my balances at my bank accounts are balanced in a way that I don't have to pay you know, charges for overdraft. So people use FX swap a lot for funding. Now, would that be subject to additional cost by, you know, like CVA charge? That's an issue. So that's one thing I think would make sense, to make sure that the regulation is the same across different countries.
So what's the timeline of starting to see these implications flow through to the bottom lines of the corporates themselves?
So I think that, you know, my understanding is that towards the beginning of 2014, we'll see something already in Europe being implemented. If I recall correctly, this is also the time of the FTT, so the financial transaction tax, or Tobin, also known as Tobin tax, that the European Union wants to implement towards the end of the year. So that's, again, 6 months. So I think in this respect, Europe is a bit ahead of the curve. And then I think that in the US, we still need to see what is the consensus, you know, between the SEC and the CFTC, what will be eventually implemented, and also would you mentioned 3 years for you know, Dodd-Frank anniversary, if you like, but would it be softened, because we hear that, you know, members of the House actually want to weaken a bit the again, because financial actors are lobbying against the additional cost and are concerned that this could put them in a disadvantage as opposed to other players in the global market.
So if I'm sitting down and making a checklist for readiness, what should I be watching first? And why don't we just focus on corporate, since we spent a lot of time on them?
Yeah, so one thing you want to watch as a corporate, especially as a U.S. corporate or as a corporate that is doing business in the U.S., would they be exempt from CVA charges or not? Okay, that would apply also to pension funds. What about, you know, the requirements in terms of cross-border activity? When is it also depends on the derivatives that you trade, if you trade as a corporate. So for instance, when would FX options be obliged to trade as a part of a SEF, right? So a swap execution facility. For now, that's not the case. So you have to follow. I'd say you have to look at regulation coming out of Europe, so ESMA and EMIR. You want to look at the regulation coming out of the US. Okay, and you want to make sure, and you want to also to check by the type of the activity that you do, because regulation will not be just one block that is dropped in one occasion and that's it. It's something that evolves over time. So you need to see what kind of domains of your activity are now being liable to or subject to the new regulation.
Well, Udi, thank you so much for the insight, and I think we will have a couple more things to talk about in the future, is different implications as we're continuing to see the phased rollout, if you will,
Yes.
of regulatory regime change. And we want to hear your thoughts. So if you're on Twitter, follow us along at NX Analytics or on our blog, where you can give feedback to any of the topics that we sit down and talk about today. Udi, thank you so much.
Thank you.
And we'll see you next time.